So you want to own a storage facility. You've seen them 1,000 times. Rows of orange or blue doors behind a chain link fence, sitting on the edge of almost every town in America. You've probably never once wondered who owns the one near you, or how a building full of empty rooms with nothing but a lock on each door turns into one of the most reliable fortunes in American real estate. Here's what almost nobody tells you before they build one. The advertised price you'd see driving past the sign is designed to lose money on purpose. The real profit doesn't start until 11 months after a tenant moves in, once they've quietly forgotten the unit even exists. And the single biggest threat to this entire business isn't the economy, isn't a recession, isn't even competition. It's a government moratorium that, strangely enough, might be the best thing that ever happened to the people who already own one. The self-storage industry in the United States generates over $44 billion a year, spread across roughly 52,000 facilities and more than 2 billion square feet of rentable space. That's not a niche. That's an entire hidden economy built on people's stuff. And by the end of this video, you'll understand exactly how that money actually moves, what it costs to get in, and the one psychological trick this entire industry quietly depends on to stay this profitable. Here's the thing worth remembering before we get into a single number. Almost nobody rents a storage unit because life is going well. A marriage ending, a parent's house being emptied out after a funeral, a move that happened faster than anyone planned for. Every dollar this industry makes is quietly built on top of somebody else's disruption. And understanding that is the key to understanding literally every decision an operator makes, starting with the ground they choose to build on. Let's start with the ground itself, because everything else in this business gets built on top of a decision most people never think carefully about. Land typically makes up 25 to 30% of a self-storage project's total development cost. That number alone should tell you something. This isn't primarily a construction business. It's a real estate business wearing a construction business's clothes. The site itself needs to be somewhere between 2.5 and 5 acres for a mid-sized facility, visible from a road people actually drive on. Because self-storage is a business where foot traffic doesn't exist, but eyeball traffic absolutely does. A facility tucked behind an industrial park with no visibility can sit half empty for years next to an identical facility on a busy corridor running at 90% occupancy. Once you've got the land, here's where the real spread in this industry becomes obvious, because the type of building you choose changes almost every number that follows. Imagine for a second you've inherited 5 acres on the edge of a growing suburb, and you're standing on it trying to decide what to build. That single decision, drive up versus climate-controlled versus multi-story, is about to determine almost every dollar figure in this video. A single-story, non-climate-controlled facility, the classic drive-up model with roll-up doors and asphalt drives, costs somewhere between $30 and $85 per square foot to build in 2026, depending heavily on region. This is the cheapest, fastest path into the industry, and it's the model most first-time developers choose. Add climate control, meaning insulation, HVAC systems, vapor barriers, and interior corridors, and you're looking at an additional $12 to $30 per square foot on top of that base number, pushing single-story climate-controlled builds into the $80 to $120 range. Go vertical with a multi-story facility, the kind you see in dense urban markets where land is too expensive to build outward, and construction costs climb to somewhere between $55 and $170 per square foot once you factor in elevators, structural steel for elevated floors, fire suppression systems required by code, and full building envelopes. Here's a translation that actually matters. A 25,000 square foot facility, roughly the minimum size serious operators consider worth building today, can run anywhere from under $1 million for a bare-bones single-story drive-up in a cheap market to well over $3 million for a climate-controlled build in an expensive one. A 50,000 square foot facility, the size that starts attracting real institutional attention, can land anywhere between $3.5 and $7 million in hard construction costs alone, before land, before permits, before a single tenant ever shows up. And that's before you count labor, which deserves its own honest explanation, because it's the single largest line item hiding inside every square foot figure you just heard. Construction labor for self-storage averages around $26 per square foot nationally, but that number swings hard by region. Sunbelt markets like Texas, Florida, and the Carolinas typically run $23 to $38 per square foot in total building costs, thanks to more competitive labor pricing. California, the Northeast, and other high-regulation markets can push $38 to $62 or more per square foot, driven by higher wages, stricter codes, and permitting timelines that can stretch a project by months before a single shovel hits the ground. Layer on top of all of that what the industry quietly calls soft costs, architectural and engineering fees running 5 to 8% of total construction spend, permits, inspections, and site preparation work like grading, drainage, and utility runs that can swing a budget by tens of thousands of dollars depending on how difficult the site is. All told, soft costs typically add another 15 to 25% on top of hard construction numbers. A single-story facility usually takes 6 to 9 months from groundbreaking to opening its doors. Go multi-story or climate-controlled, and that stretches to 9 to 14 months, with another 3 to 6 months of permitting before construction even begins. This is not a business you build on a whim over a weekend. Now here's the part almost nobody explains clearly, and it's the single most important number in this entire industry. Once the doors are built, this business doesn't make money the way you'd assume. It makes money in an order that surprises almost everyone who hasn't studied it. Before we get to that, a quick word on how most of this actually gets paid for, because almost nobody is writing a check for the full construction cost out of pocket. Most developers combine personal capital with bank financing and specialized options like SBA 504 loans, a government-backed program specifically designed for exactly this kind of owner-occupied commercial real estate project, often allowing a developer to put down as little as 10% while the loan covers the rest. This is precisely why the 18 to 36-month lease-up period matters so much. You're not just waiting for revenue to show up, you're making full loan payments on the entire construction cost every single month, whether the building is 10% full or 90% full, which means underestimating how long stabilization takes is the single fastest way a promising storage facility turns into a genuine financial strain on its owner. Think about it the way you'd think about a gym membership, except from the other side of the counter. You sign up excited, pay the first month, and fully intend to use the treadmill every single week. Then life happens, and you keep paying anyway, month after month, because canceling feels like more effort than it's worth for something you're not actively using, but also aren't quite ready to let go of. Self-storage runs on an almost identical psychology, except instead of unused gym equipment, it's a couch from an old apartment, or a dead relative's furniture nobody's emotionally ready to sort through yet. The tenant isn't paying for the unit, they're paying to not have to make a decision this month. And that reluctance to decide is worth more to the facility's bottom line than almost anything else on this list. A brand new facility doesn't open at full occupancy. It takes 18 to 36 months to reach what the industry calls stabilization, the point where occupancy settles into its long-term normal range. During that lease-up period, you're paying full construction debt service on a building that might only be 30 or 40% full. This is the single biggest reason new self-storage developers underestimate how much cash they actually need. The building isn't the expensive part. Surviving the empty months after the building is finished is the expensive part. Once stabilized, the target occupancy range sits between 85 and 92%. Below 80% typically signals a real problem, a bad location, poor management, or too much competing supply nearby. Above 95% actually means something counterintuitive. It means you're probably undercharging, because a truly well-run facility should be gently losing a small percentage of price-sensitive tenants to competitors while replacing them with tenants paying market rate. Revenue per square foot nationally averaged $16.22 as of April 2026, though this varies enormously by market, running higher in dense coastal metros and lower in small towns. A standard 10 by 10 unit, non-climate controlled, rented for around $119 a month entering 2026. Climate-controlled units of the same size commanded around $134, a 25 to 50% premium that more than justifies the extra construction cost over the building's lifetime. Here's where it gets genuinely interesting, and where most people watching this get the entire revenue model backwards. The rate a facility advertises to attract a brand new tenant, called the street rate or move-in rate, is almost never the same as what long-tenured tenants are actually paying. Move-in rates in late 2025 averaged around $96.44, down over 10% year over year, reflecting aggressive discounting to win new customers in a competitive market. But in-place rent, what existing tenants actually pay after being in a unit for a while, sits meaningfully higher, with major operators reporting realized rent per occupied square foot well above what new move-ins are paying. The entire industry runs on a strategy the operators call existing customer rate increases, quietly raising the rent on tenants who are already moved in, typically $10 to $20 every 6 to 12 months. Because moving your stored belongings again is such a hassle, most tenants simply pay the increase. Move-out rates after a rent increase typically run only 2 to 5%. The average storage customer stays 12 to 15 months, and plenty stay for years, which means the low, flashy advertised rate you'd see driving past the sign is genuinely a bait. Not a trap exactly, but a deliberate loss leader designed to fill a unit that will quietly become more profitable every year the tenant forgets to leave. Here's something worth pausing on before we move further, because it explains why two facilities that look nearly identical from the street can perform completely differently on paper. Unit mix, the specific breakdown of small, medium, and large units, climate-controlled versus drive-up, and even outdoor parking for vehicles, has a bigger impact on total revenue than almost any other single decision an operator makes. A facility built with too many oversized units in a market full of apartment renters storing a few boxes will sit half empty in its biggest, most expensive to build category, while a facility with too many small units in a market full of homeowners downsizing an entire house will constantly turn away customers who need more space than exists on site. Getting this wrong doesn't show up as a single bad decision. It shows up quietly, every month, for years, as a facility that never quite hits the occupancy numbers the spreadsheet promised. This is also where outdoor vehicle storage quietly earns its place on almost every serious operator's site plan. A section of gravel or paved lot, sometimes covered, sometimes not, rented out for RVs, boats, and trailers, costs a fraction of what an enclosed building costs per square foot, yet commands genuinely meaningful monthly rent, especially in markets near lakes, campgrounds, or suburbs where HOA rules ban parking a boat in your own driveway. It's some of the highest margin square footage on an entire property because the construction is closer to paving a parking lot than erecting a building. Over 90% of institutional self-storage operators now use dynamic pricing software, tools that automatically adjust street rates in real time based on occupancy, local competitor pricing, and seasonal demand patterns. The same underlying logic an airline uses to price a seat differently depending on how full the plane already is and how many days remain until departure. Independent operators still running static handset pricing are, according to industry analysts, consistently leaving meaningful revenue on the table every single month, simply because a human being checking prices once a quarter can't react as fast as software checking them every day. Here's the twist most people watching this haven't considered yet. Rent isn't even the whole business. There's a second revenue stream running quietly underneath the rent, and it costs the operator almost nothing to collect. Tenant insurance is, almost embarrassingly, one of the highest margin pieces of this entire business. Most facilities require tenants to carry insurance on their stored belongings and offer it directly at $10 to $15 a month. With 300 tenants, that's $3,000 to $4,500 a month in revenue that costs the operator almost nothing to provide, since most facilities simply act as a referral partner to a third-party insurer and collect a fee. Add retail sales of locks, boxes, and packing supplies, small individually but high margin in aggregate, plus referral fees from truck rental partnerships with companies like U-Haul, plus late fees, administrative fees, and premium services like package acceptance. Ancillary income of this kind typically makes up 5 to 10% of total facility revenue, and it's some of the closest thing to pure profit anywhere in the business, because none of it requires building another square foot of anything. Now the expense side. Because a business this profitable sounding still has real costs eating into every dollar of rent collected. Total operating expenses for a well-run facility typically run 30 to 45% of gross revenue. Staffing is usually the single largest category, 10 to 15% of revenue, though this number has been dropping fast as the industry automates. Facilities with automated gate access, online rental platforms, digital payment processing, and remote video monitoring have cut per facility labor costs by 30 to 50% compared to a traditionally staffed location with someone sitting behind a desk all day. Property taxes, insurance, utilities, and routine maintenance typically add up to another $2 to $4 per square foot annually. Marketing, digital ads, local promotions, referral incentives rounds out the expense stack. After all of that, the average self-storage business runs a net profit margin of 41%, with well-managed facilities at stabilized occupancy typically landing between 30 and 40%. and the highest performing operators exceeding 50%. Compare that to the all-industry average profit margin of roughly 22%, and you start to understand why serious real estate investors treat self-storage less like a side hustle and more like one of the most efficient asset classes available. A metal building with doors, no plumbing inside individual units beyond the office, minimal build-out required between tenants, and margins that would make most other commercial real estate categories jealous. Here's the part of this video that changes how you should think about the entire industry, because it's not really about rent at all. It's about what this business does during the exact moments life falls apart. Remember what we said at the very start, that almost nobody rents a storage unit because life is going well? Here's what that actually looks like at scale. Self-storage demand isn't driven by the economy. It's driven by life events: moving, downsizing, divorce, death in the family, a new baby needing a spare bedroom back, a business outgrowing its office. None of those events wait for a good economy, and several of them actually increase during a bad one. During the 2008 financial crisis, self-storage occupancy nationally dipped from around 90% down to 82%. That sounds like a real hit, until you compare it to office space, which cratered into the 70s, or retail, which saw waves of outright vacancies and closures. Self-storage didn't just survive the recession better than almost anything else in commercial real estate. It bounced back faster too, because rising rents and shrinking homes during a downturn pushed more households to downsize and store the overflow rather than throw it away. During COVID, the pattern repeated in an even more extreme way. Occupancy at major operators actually surged to nearly 97% by the third quarter of 2021, as a construction freeze during the pandemic meant no new competing supply was hitting the market right as demand for extra space, home offices, gym equipment nobody wanted to throw out spiked simultaneously. Self-storage REITs were, remarkably, the only major real estate sector to post positive returns that year, up around 5%, while the broader REIT market fell nearly 37%. Now let's talk about who actually owns this industry, because the answer has been changing fast, and it explains why you're seeing fewer small, independently owned facilities and more branded, corporate-feeling ones every year. Here's how this actually tends to play out, in a composite of what happens over and over across this industry. A local owner buys a rundown, half-empty facility from a retiring operator. 40,000 square feet, no climate control, handwritten ledger instead of software. Year one is brutal. Occupancy sits in the 60s, barely covering the loan. He spends that first year doing something almost nobody wants to do, raising rent on existing tenants in small increments every few months instead of chasing new customers with discounts. By year three, occupancy has climbed past 90%. Tenant insurance and retail add-ons are covering nearly all his fixed overhead by themselves, and the facility is throwing off 6 figures a year in pure profit. He didn't build anything new. He didn't invent a better storage unit. He just understood something the previous owner never bothered to learn. The money was never in the tenants walking in the door. It was in the ones who'd already forgotten they were paying. Public REITs, the large publicly traded real estate investment trusts, now control roughly 40% of national self-storage capacity, up from just 20% 5 years ago. Names like Public Storage, Extra Space Storage, CubeSmart, and national storage affiliates dominate this list, and the consolidation has been accelerating dramatically. In March 2026 alone, Public Storage announced a $10.5 billion acquisition of national storage affiliates, one of the largest deals in the sector's history. These companies aren't just buying buildings. They're buying the exact operational playbook this video just walked through: the dynamic pricing algorithms, the automated staffing models, the ancillary revenue systems, and scaling it across thousands of locations simultaneously. This actually creates a genuine opportunity for smaller, independent operators, and it's worth understanding exactly why. More than 15 states have enacted moratoriums or serious restrictions on new self-storage development since 2019, driven largely by neighborhoods pushing back against yet another storage facility going up on a corner they'd rather see used for something else. That regulatory friction, frustrating as it is for a new developer, is quietly protecting every facility that already exists, because it's choking off the exact new supply that would otherwise compete away your pricing power. Existing facilities in supply-constrained markets are sitting on something increasingly rare: a genuine, government-reinforced moat. Let's talk numbers on the buying and selling side, because this is where the entire industry's incentive structure becomes completely clear. Self-storage facilities are valued almost entirely on a single method: capitalization rate applied to net operating income, commonly shortened to cap rate and NOI. In 2026, cap rates for self-storage typically range from 5 to 7.5%, depending on market quality, translating to roughly 13 to 20 times annual net operating income. A 100-unit facility in a rural market might sell for $300,000 to $700,000. A 300-unit facility in a solid suburban market might run $2 to $5 million. Institutional quality, climate-controlled facilities in major metros can sell for $10 million or more. The median transaction price for facilities changing hands nationally sits somewhere around $1.5 to $3 million, which tells you the real center of gravity in this industry isn't the mega facilities you see REITs bragging about. It's the mid-sized, unglamorous facility that a private buyer or small partnership can actually afford to acquire. And here's the strategic decision that separates the operators who build real wealth from the ones who just own a building. Buying an existing, already stabilized facility skips the entire painful 18 to 36-month lease-up period this video described earlier. You're not betting on whether tenants will show up. You're buying a facility that's already proven, month after month, that they do. The trade-off is you're paying a premium for that certainty, reflected directly in the cap rate. Building from scratch means enduring the empty months, but potentially capturing more long-term value if you develop in the right location before competitors notice it. Most experienced operators eventually do both, buying a stabilized asset first to generate reliable cash flow, then using that same cash flow and the equity in that first property to fund a second, riskier ground-up development once they've learned exactly how their specific market behaves. So here's what all of this actually adds up to, and it's worth sitting with for a second, because it explains why this industry keeps attracting more serious money every single year, despite looking from the outside like nothing more than a fenced-in field of metal doors. This is a business built on real estate fundamentals: land, construction, and location. Wrapped around a math problem almost every tenant unknowingly solves for you. The advertised rate gets someone in the door. The quiet, repeated rent increase on tenants who've already moved their stuff in does the actual work of building profit. Ancillary income on top of that, insurance, retail, referral fees, adds margin that costs almost nothing to generate. And underneath all of it sits a demand curve that doesn't care whether the economy is booming or breaking, because people don't stop moving, downsizing, divorcing, or losing a parent just because interest rates went up. The building itself was never really the business. The business was always the 11 months after move-in, the ones where a tenant quietly forgets they're paying for a unit they visit twice a year, sitting behind an orange door they drive past without a second thought, exactly like you have more times than you'll ever bother to count.